What's going on, guys? Wanted to jump back on here, get our monthly market update going. Believe it or not, it is the beginning of August now. Summer's basically over. It's kind of insane. At least up here in Northern California, our winter felt so dang long that it seems that summer wasn't even really a thing. But I was talking to actually one of my clients this week, and she's a teacher at a local high school. And she told me the kids are already back on campus. They're getting their classes selected, getting their books, and actually starting Monday, school is full blown back in session, which seems absolutely insane. I feel like we started a lot later back when I was in high school, but yeah, it's gone. It's back in action for everybody. So got to also repping the Masters polo. Been a while back. I told you guys about it on one of these videos that got to go to the Masters this year. So supporting all the swag that we got from there. But anyways, wanted to let you know what's going on with the markets, what's going on with the portfolios. There's been some big headlines that came out this week, so wanted to address that as well. But just looking at all the numbers year to date here, looking at the major indexes, the Dow is up about 6.5%. So it's actually the worst performing of the three. If you remember, last year was actually the best performing, but still up 6.5%. S&P has been doing really well, 17.5% on the year. The NASDAQ tech heavy index killing it, up over 40% on the year, really being led by just a few names: Nvidia, Netflix, Apple, Amazon, Google, some of the top names that you guys know of. They have been absolutely killing it. And then I also want to quickly look at the banks that we bought into. Huntington Bank down about 11% on the year. Charles Schwab down about 20%. KeyBank down about 29% on the year. But just remember, we didn't buy into these on January 1st. I mean, this data right here is from January 1st up until August 3rd today when I'm recording this. We didn't buy into those. So that's not the actual performance that we've had in our portfolios. We bought into these in about April. But if you remember, I talked about this last month, I believe. But the reason we really did buy into these is just from a valuation perspective. These companies were trading for less than their actual company was inherently worth, which is just crazy. Normally the prices that companies are trading for within the stock market are 100 times what the companies are actually worth at these crazy valuations. So they were so cheap. And again, I know we covered this last month, but from their balance sheets are still really, really strong. They have really good business models. I mean, they're just screaming deals, and that's why we bought in. Again, it was a little bit early. We did see a little bit of downside pressure right off the bat when we did buy them. But I just wanted to show you now, looking here quarter to date, how well they have been performing. And this is really why we bought into them. I mean, we're still very bullish. Again, when we're doing our valuations that we do and going through the process that we go through in order to decide which stocks to buy, it doesn't always mean that we're going to get it right at the perfect time, but we're always buying things for the long term. We're not just looking at what's going to happen over the next month, 2 months. I mean, we're looking at years in advance. So we're long term still holding these. We talk about them, every couple of weeks. We reflect back and kind of see what our price targets are and such. So as of now, no chances of selling them in the near future. But I just wanted to show you how strongly they've been performing over the last quarter to date here. As you can see, S&P, NASDAQ, and the Dow all roughly around 1% to 2%. Key Corp is up 30% almost during this time period. Charles Schwab up over 16%, and Huntington Bank up over 13%. So again, they're starting to pan out, just like we thought from why we decided to buy them. They're killing it. They're heading in the right direction, and we don't see any reason to be selling them in the near term. So just wanted to keep you guys updated. The Sierra Ridge portfolios have been absolutely dominating the benchmarks during this last 3-month period, and really led by these bank stocks that we bought into. So that's kind of moral of the story of what's been going on lately. No real changes to anything in the portfolio. Still holding that LGOV, long duration bond fund, that we talked about last month. So nothing really new on the investment lineup front. But let me know if you guys have any questions with that stuff. Looking at the major headlines of what happened this week, I'm sure that you guys may have heard about it. I was actually talking to a buddy that's a CPA yesterday evening, and he said nothing that he was listening to had talked about this, which I was kind of surprised. I thought it was all over the news everywhere, but the U.S. debt got downgraded, right? So basically, Fitch, which it's not Abercrombie and Fitch, it's Fitch Ratings. They downgraded the U.S. debt. We used to be at a AAA rating. Now it's at AA plus. I mean, it's kind of silly. It seems to be kind of a political move. Again, believe it or not, Republicans are happy about this. Democrats are not. Weird with an election coming up, right? But I mean, when we're looking at this, Senate Majority Leader Chuck Schumer blamed House Republicans for the downgrade, saying in the statement that their reckless brinksmanship and flirtation with default has negative consequences for the country. So it's just to be expected. I mean, again, it seems like a lot of just political, just kind of silliness that's going on. I don't think it's going to have a very big effect on things. I mean, yes, when this happened, the market did respond poorly. Everything was down. I mean, kind of a bloodbath out there. The S&P was down like 1.5%. NASDAQ down over 2%. Everything was kind of getting smoked when this news came out. But that's just a short-term reaction. Again, that's why I talk so much about going through the financial planning and talking about the long term, because we can't plan for all the noise that's going to happen in the short term. I don't know what's going to come out on the news tomorrow. You don't know what's going to come out on the news tomorrow, and we can't control it. I mean, we have no influence on whether or not U.S. debt gets downgraded, which is a complete whole nother story. I mean, it's crazy to me to think that there's an association out there that can just decide that they're going to downgrade the U.S. debt just because, it took a little while for them to agree on the budget, which happens all the time. Again, if you remember another market update that we talked about, it was an insanely large number, like almost 100 times or maybe more than that the U.S. That the political offices had taken a long time to agree on the budget and actually increase the budget deficit. And it's all kind of silly. So for that being the reason for them to downgrade U.S. debt just seems a little absurd. But again, it's not like it got cut all the way down to a C rating. It's at AA plus still. So short term, yeah, it's adding a little bit of volatility, maybe scared some people, but we don't really care about, the next 3 weeks, the next month. We're still investing for the next years to come. So really not very worried about this short-term narrative that's been going on. What could happen and why did it scare people? Of course, when you're investing in bonds, it doesn't matter whether it's the U.S. government or your local, small company. You are still interested in their credit rating. So if it's a C-rated bond, yeah, you're going to get a higher yield on it, but there's a higher possibility of that company defaulting and you not getting your money back, which is, most people, the reason that they invest in bonds is for safety. It's for, being conservative. It's for leveling out the overall volatility of your portfolio. So most people want to invest in highly rated, lower yielding bonds. So of course, if the U.S. debt is getting downgraded, that's a scary thing because that's supposed to be the biggest safe haven in all of the market. I mean, investing in U.S. Treasuries is supposed to be like the best place that you can park your money to get consistent returns. And if that falls out, I mean, then the backbone of what you're getting from bonds in general, I mean, that's kind of a scary thought. Also, there's with larger pensions and larger retirement plans and such, they have thresholds on how high of a credit rating your bonds must have. So people were saying, oh, well, maybe, they're going to have to take U.S. Treasuries out of some of these pensions. No, that's not going to happen. I mean, there's no way that people are going to say, oh, because U.S. Treasuries are now downgraded to AA plus instead of AAA, they're not very safe anymore and we shouldn't hold them. I mean, that's just not going to happen at all. And even Alec Phillips here, chief political economist for Goldman Sachs, said, we do not believe there are any meaningful holders of Treasury securities who will be forced to sell due to a downgrade. Large U.S. banks that are required by regulators to hold U.S. Treasuries won't see any changes in those rules just because of the downgrade. I mean, again, it's not going to have a crazy large effect. People are not going to be fleeing from investing in U.S. Treasuries just because of this small downgrade. It actually happened also in 2011 was the last time that U.S. debt was downgraded. So you probably didn't even remember that had happened. We're not going to remember that this had happened far in the future. So it seems like more of a political debate that's going on rather than an economical debate. I don't think it's going to have much of worry at all. Nothing that we need to do drastically within the portfolios to accommodate for what we're seeing here. So that's really it for this month, guys. I mean, nothing too crazy. I just kind of wanted to give you an update, make sure that you knew what was going on. We haven't made any major changes wanted to quickly address the debt downgrade. Of course, I'm sure that that's going to be something that you're going to see on TV or hear from some other people. And then just let you know, again, nothing crazy that we've done to the portfolios right now. We're still keeping a close eye on what the Fed's telling us. They came out and raised rates again this last month, which is to be expected. They probably will at least one more time. But keeping a close eye on that. And I will let you know next month if there's been any more changes or some more updates to the portfolios and what else is going on. So hope you guys enjoyed the summer. Enjoy the next couple weeks before you have to send the kids all back to school. And we will be in touch. Let me know if you have any questions. Always happy to chat with you. Take care, guys. Bye.